The views and opinions provided on this show are for informational purposes only and should not be misinterpreted as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, please go to passiveinvestorshow.com. Hey PI listeners, this is John Fortes. I'm making it a point to speak to as many investors as possible. My goal is to position myself to be a blessing to my network through conversation. How could one be a blessing through conversation? The easy answer is by listening. A simple conversation can open many opportunities and doors. I always ask myself this: what do I have to lose by having one more conversation? Going back to high school, I've connected friends and family in my network to one another, even if it didn't benefit me. And I continue those same principles and practices. Why? Because it's the right thing to do. If I can't help you, I probably know someone or something that can probably solve your problem. I'd love for you to become a part of that network. Go to www.johnfortes.com, create your investor profile, and schedule a call. How can I best serve you through conversation? In the words of Clarence the Angel from It's a Wonderful Life, no man is a failure who has friends.
And now, the Passive Investor Show. Here's your host, John Fortes.
Welcome, PI listeners, to the Passive Investor Show. I'm the Passive Investor Consultant, John Fortes, your host of the only ranked podcast for passive investors in multifamily syndications and real estate funds. Our goal and purpose of this show is to be a resource to investors and help them master their passive investments by beating inflation 1% at a time. Welcome, PI listeners, to the show. Today, I have a special guest. I have Ashley Wilson. Ashley Wilson is the co-founder of Bar Down Investments. And How's It Look? You gotta read that. How's It Look? I love the way it's written, man. I love that. Best-selling author of The Only Women in the Room, knowledge and inspiration from 20 women real estate investors, and an active member of the Real Estate Invest Her community. She has over 10 years of real estate experience and has been involved in over 60 million in transactions within both single and multifamily real estate. Ashley co-founded Bar Down Investments, LLC, with her husband, Kyle. Ashley leads asset and construction management on her multifamily investments and has provided operational consultant for several other large multifamily owners throughout the country. Additionally, Ashley and her father, Tom, also have a very successful high-end flipping business in Pennsylvania, How's It Look LLC, which handles several million in transactions annually. When Ashley is not working on her businesses, she enjoys spending time with her family, including her husband and their 2 daughters. Additionally, Ashley enjoys competing with her horses. Wow. Welcome to the show, Ashley.
Thank you so much for having me.
No, I'm really excited to have you on the show to really break down exactly what you do. Can you share with us your background and how you got into it?
Absolutely. So I got into real estate investing about 10 years ago. My husband and I were both looking for a way to diversify our retirement strategy. And we were not really interested in putting our money in the stock market. So we kept circling back to real estate and ultimately landed in real estate. We started initially continuing to work full-time and passively invest, and that transitioned into me leaving my W-2, working full-time in real estate about 6 years ago. And then my husband, once he retired from his career, he transitioned about 3 years ago. So we've been in real estate for the past a little over 10 years. We've been full-time myself for over 6 years, in multifamily specifically for about 2.5 years.
Awesome. Thank you for sharing that, your background and how you got here. But when did you start working with passive investors?
We started working with passive investors about a little over 2 years ago, about 2.5 years ago, with our first syndication. So we actually, I partnered with a group and led asset and construction management on a property located in Houston, 124 units. So that was my first I don't know, first experience working with passive investors, we had never taken passive investors on our single family business. We have different equity sources for that. But for the multifamily, we started working with passive investors and we continue to work with them today
So are you based out of Pennsylvania?
in the suburbs of Philadelphia.
Awesome. So reason why I asked is you asset managed construction in Houston. How did that work?
Well, it's interesting because I think everything leading up to, getting into real estate positioned me well to be able to manage from afar. So when I worked at W2, I worked in pharmaceuticals and I worked in global research and development. So I was managing projects in the US all over the world. And then from there, I became a manager of global managers. I became, the director of global managers. So once again, I was managing managers all over the US, managing global projects. And then when I started my flipping business, I was living in Europe. So I lived in Europe and Russia for 4 years. And I started my flipping business while living in Europe with my flipping business back in Pennsylvania. And then clearly with multifamily, I mean, that's never been a challenge for managing from afar for me because my entire career has been managing from afar.
Awesome. Football season. So Steelers fan?
No, Eagles. I don't know if I
I,
really should say that though, because they are miserable all this year, but maybe I
I
should
just
say Pittsburgh.
I just thought I'd throw that in there. All right, let's move on. What criteria do you look for with passive investors in the last 2 years since growing your firm to handle passive investors?
Yeah, so that has kind of changed over the past 2 years. When I initially started, I was really into, my family and friends circle and really bringing them over to real estate and showing them all the benefits of real estate. Specifically, tax advantages are just unbelievable in the passive investing space. So, just educating investors, that was a lot of time spent educating investors about the advantages. And then from there, it's kind of grown. So, I do podcasts like this and other podcasts. And I've been very fortunate that people listening reach out and talk to me about investing. So, what I'm looking for in passive investors, I really, want someone who, I mean, they're partners essentially, right? So just like you look for partners, outside in the GP space, the general partner space, not the LP space, you want to fit. So I find that our passive partners are people who really have a lot of trust in what we're doing. It's not that I have to sell them on my commitment to the investment. I feel like if I have to sell them on my commitment to the investment, they really don't know me because I'm probably one of the most passionate people about real estate that you will ever meet. That's something, that's really important to me. They don't necessarily, we do 506C offerings, which means that we are looking for accredited investors. They don't necessarily have to be well educated in the real estate space for us to, start the relationship and offer opportunities to them. It's up to them how much detail they want to know or how little detail they want to know. But we really work with them to just make sure they understand the risks associated with investing.
Yeah, that's very important because sometimes as a working professional, they're focused on their profession, what they're really good and contributing to the world doing. And maybe they enjoy it, but they don't want to take on as much education as you shared with maybe someone earlier in your investment as you started taking on passive investors. So that's great to highlight that. But what does your onboarding process look like when, say, maybe even someone that's referred to you or reaches out to you on a cold call?
So if someone is referred to me or reaches out on a cold call, I always have a conversation with them. I touch base with them over the phone, introduce myself, understand where they are in their investing process and their journey. Are they new to real estate investing? Are they new to investing, period? Or are they a seasoned expert? And then I tailor the conversation based off of where they're at in their journey and then try to get them to, the next step in their journey and understanding. People may find this strange, but I also too, if I don't have an investment at that time and they're looking to place capital immediately, I will refer other investors that they can look to invest with. And people think that's counterintuitive. They don't want to share their investors, but ultimately I think that the more you do for, promoting and doing good things for your investors, the more they'll come back to you. They'll realize that you're a source that provides good quality information. Now, I'm not endorsing specific investments, but what I'm doing is just saying, I know this is a credible person. They typically have offerings. I don't know whether or not their offerings are good. I can just tell you that, they have a good reputation and you might want to look into them further. And then oftentimes what will happen is they'll circle back to me and say, hey, can you take a look at this investment for me and let me know your thoughts? And what I'll do is I'll look at the investment and then I'll just tell them some risks associated with it and, some good things about how they've underwritten the investment to allow the investor to make the decision themselves. That's typically someone who's new to investing. But what I'm trying to do is educate themselves, and I'm not telling them something that later I don't want them to challenge me on. So the whole point is educating people so that they can make informed decisions, because if someone is more willing to take a risk versus someone isn't, then you should match your investment based off of your appetite for risk.
I really appreciate you sharing that because, being in the industry for a couple of years now and obviously growing and expanding your network, it's something that I really believe and I love that you do because of the fact that you're not referring, you're recommending, but thing where you give out and you provide someone of value something, and maybe it's that investor is going through that experience on an opportunity of maybe even sourcing and vetting the sponsor where maybe you didn't have a deal for them to do that at that time. But only thing that they're doing with you is vetting the sponsor, having that conversation with you, right? So now they get to go through that whole situation with someone else. And also every situation with the sponsor investment onboarding process is different from firm to firm. These are small startup companies. Some of them are big, some of them are smaller, but also, the experience is different for everyone. So thank you for sharing that, man. I really, really love that you are a giver like that.
Absolutely.
What is something you had to implement in your business as a result of working with passive investors?
Just really knowing when the cutoff point is, maybe, an investor not being a perfect fit for something we're looking for. There is a certain threshold that I get to with a passive investor. And then I just have a conversation with them and say, maybe investing with us isn't a good fit for where you're at right now. Maybe you want to look into some other investments. So that's something that we've had to implement, because there are really two schools of thought. One is that you take any and all money that comes your way, and two is that you take the money that fits your needs and your team's dynamic. We're the latter. We know, I mean, it's common sense. We didn't have to go through it to know that there are inherent challenges when you just accept any and all money thrown at you. And we're a person of our word and we really stand by our reputation. So it's really important to us that we're, meeting people's expectations. And if people have unrealistic expectations, then, maybe that's not a good fit. So we don't want to set anyone up to be upset, not even for us to be frustrated, but for them to be frustrated as well.
I want to ask you one thing in regards to what kind of impact has investment opportunities had on your passive investors that you provide from your firm?
I think knowledge is power. So ultimately, what we're doing is we're providing transparency and we're providing education and knowledge when we're going through our updates on the property. And ultimately, that allows that person to be a stronger investor, whether they invest with us or other people. At the end of the day, like, if you think about it on a macro level, if your investors are doing exceptionally well, they have more money to invest with, right? So if they have more money to invest with, that makes it easier for you to source your deals and fund your deals. So that gives you more bandwidth to be able to go out, at least from a capital equity stack side, and be able to fund larger and larger deals. So ultimately, if you're providing a lot of knowledge and a lot of value to your investors outside of just the monetary returns, they're going to be able to maximize their investments, not only investing with you, but investing with other people. And it's a domino effect. They'll be able to grow their wealth.
I know that each deal is different What's usually the deal structure you guys are offering investors when you're rolling out a deal? Is there a typical capital stack that you're offering, or a pref that you're offering, or a structure 70-30, 80-20? What do you guys typically across the board?
So once again, there's two schools of thought on this. One is that you offer the same sort of return structure across every deal. And two is that you do a deal by deal return structure. We take the latter. In this situation, there's not a right or wrong way. Ultimately, if you're able to find deals that you can offer the same deal structure every single time, that's ideal, because you only have to teach your investors one way of the returns being structured. It's not a learning curve on how the returns are being structured. For example, like with a waterfall structure, or a pref structure, it's a very straightforward process that every deal is structured the same way. With the scarcity of deals in the specific markets that we're looking at, we have to get more creative. So if you're the markets that we're in, which are more competitive, let's say, than a secondary or tertiary market, you're going to have to get more creative with the return structure. And our return structure, it varies anywhere from like a 6 to an 8 pref. Sometimes we can potentially even go to a 9 pref. And then we're trying to hit a targeted IRR. So however we can get to that targeted IRR, and that IRR changes. 2 years ago, our investors had a higher expectation on the IRR than they do today. So really, that IRR is kind of a floating measurement too. We always have to get a pulse of where our investors at. So that tells us the cost of capital for us on the equity side. But, we're shooting anywhere around mid-teens ideally. So like 15 IRR, that's what we're trying to target, because that's right now where our investors' appetite is. If we could get that down, that cost of capital down a little bit, we could open up to more opportunities, and that benefits the investor in the long term. But obviously it's very hard to convey that because they just see a smaller return. But ultimately, there are deals that have greater upside if investors are open to it.
Yeah, I have a different opinion about the IRR, and it's a conversation to be had with everybody. And I'm glad you brought it up, right? So usually I start looking at it when it starts hitting 13. When it starts going north of 13, start exploring the deal more and why it's higher in certain markets, certain deals, certain instances, or different situations or opportunities. So start with 13 and then go up. I understand that a couple of years ago it was in the higher teens, right? I remember that. And now it's more depending on who you're talking to, it is in that 13, 15 range. And sometimes 16, 17, you could get there. But thank you for sharing that. And now, how do you feel about the preferred return? Some investors are bullish on it, and some of them are a little bit more relaxed, because sometimes the preferred return, depending on the type of investment business plan you're doing on the project, the preferred return could hinder the project because of the fact that you're trying to meet these returns that your business plan really can't support. I understand with different projects and firms and sponsors and operators, they're building those into their business plans, right? So for instance, you mentioned 6 to 7 to 8. There's a sliding scale there, and investors need to understand that it could be 6 on this deal. How are you having those conversations with your preferred return investors than with the ones that not really focused on the preferred return?
So for the preferred return, the reason why people are bullish on the investor side, on the LP side, are bullish on the preferred return is because ultimately that shows alignment. That shows that the sponsorship group isn't heavy on the fee structure, and they're waiting for, the cash out at sale and the fees from acquisition and asset management. So I understand why. We've passively invested before. And when we invest, first of all, we invest in all of our deals. The first investor in our deals is us, right? So we always put our own capital in a deal, and then we put it on the LP side. It's not like there's a separate bucket that we put it in. So if I was a passive investor, solely a passive investor, I would want to see that pref return because that shows alignment. But to your point, as an active investor, as a general partner, it can be a long time. You're doing a tremendous amount of work, not receiving any part of the cash flow along the way. So it does become very difficult as a general partner. And as much as everyone wants to say, well, you get the asset management fee, the asset management fee is like nothing in the grand scheme of things. So you have a huge general partnership. Typically, it's not just one person in the general partnership, and it's a full-time job. It's especially when you're doing a value add situation or some sort of turnarounds on the property. I mean, it's very heavy. So I understand both sides of the argument. Ultimately, I think if there's more compression in the stock market on the average return, so historically the stock market has averaged an 8% return. And if you have more compression on the stock market, I think people's expectations on the pref return would condense as well, would compress, because ultimately I think a lot of times that you're getting passive investors that are coming over from the stock market. So their expectations are based off of historical stock market returns. And I think that indirectly impacts how we structure our return system, even with respect to the IRR. I mean, the IRR, the reason why, it's a measure of two things. It's a measure of, first of all, the availability that is within the market and the returns and the cap rates. There's an impact there, there's an influence there, but ultimately it's also influenced by the stock market, because if it was less than the stock market, you might have a harder time convincing people of the benefits, because there are people who invest because of the tax benefits, but there are people who are definitely investing just because of the returns.
Thank you for hitting that on the head. Home run. Ashley, one piece of advice for the PI listeners.
Be very diligent about vetting the team. Most people spend a lot of time vetting the deal, but the deal is secondary. It's not primary. The primary thing you should be vetting is the team. The team can make or break a deal. You can have an incredible deal with a poor team. That's a poor investment. And you can have a mediocre team with an excellent team with a mediocre deal, and the deal becomes excellent. The team is the determining factor.
That's the number one answer we always get on the show. It's the vetting, the team, the sponsor, and it just shows that you're in alignment with everybody else. I love it. Ashley, how can we stay in touch with you?
You can find me at badashinvestor.com, and there you can link to all of my companies. So it's BADASH Investor. You can also follow me on Instagram at Badash Investor.
My favorite question: what is the meaning behind your company name?
Bar Down Investments is actually a name that is done. So Bar Down is a shot in hockey and in soccer. I found out from a passive investor, but it's a shot in hockey where the puck hits the top of the crossbar and then falls in. It's considered one of the best shots in hockey. My husband was a professional ice hockey player. He retired 3 years ago. So we wanted to incorporate hockey into the name of the company. So if you look at our logo, it's actually the top down, the B and the D. People think it's just the B and the D, but it's actually an aerial view of a hockey net.
Wow, I didn't know that. That's awesome. It's genuinely my favorite question, because I'm always curious why'd you name it that? Why'd you name it that? Even if it's your name, and I've said this on the show, even if it's your name, it has some meaning to it, but I want to know what that meaning is to you. So I appreciate you, Ashley. Thank you for coming on the show.
Thank you so much for having me.
Don't forget to download your free copy of the investment tracker. It allows you to track up to 5 investments, compare sponsors, markets, and most importantly, projected versus actual returns. To get your copy, go to www.projectedreturns.com. PI listeners, thank you for listening. As always, we hope this was the best resource for your investment strategy, but also the best use of your time. Remember, if this episode helps you, you can help us by leaving a review on iTunes. I hope you feel compelled enough to share it with someone you think this would resonate with as well. As much as it pains us to leave you, but you know what time it is. Time to go put this into practice. Till the next time we meet, happy investing. PI listeners, I'm grateful for your time and I appreciate you for listening. It would mean the world to me if you went to iTunes and left a rating and written review. Let me know how you feel about the show. It really makes a big difference with getting the podcast out there. Don't forget about our Facebook group. where all of our guests are members of. I'll be there to answer any of your questions, or even questions you might have for future guests. Subscribe so you can get the latest episodes and our fan favorite quick hitters. Finally, I want to keep you updated, so head over to johnfortes.com and sign up for the newsletter. If you're interested in partnering with me, sign up on the contact page so you can talk to me directly. I look forward to connecting with you. Happy investing.